Jewelry giant Tiffany & Company reports second quarter earnings before the markets open on Thursday. Now, consumers are gaining steam, but will the current volatility in the stock market keep people out of the luxury retailer's stores? Here to preview Tiffany's results is Paul Swinand, an analyst with Morningstar. All right, Paul, it's good to have you here. Let's start off more broadly. What are you looking for in Tiffany's results?
Well, we rate Tiffany as a wide moat stock, so it's a stock that we like for the long term because they have incredible competitive advantage and incredible brand. I'm actually thinking that the U.S. market was a little tepid over the summer. Maybe a little bit was tourist demand with the high dollar, and also just the weather and some other retail factors with the calendar made retail a little soft over the summer. So I'm not bullish on the quarter, but I'm getting a little more bullish on the long run now that Tiffany's stock is below our fair value.
All right, and you also have a hold rating on the stock. Tell us why.
Yeah, so we try to figure out what the stocks are worth today, and we think Tiffany's worth about $89. You'll recall it traded up, I think, over 100 earlier in the year. Now with all this volatility, the stock's gotten a lot cheaper. That means that probably people are, like me, maybe expecting a little bit of weakness in the quarter, or maybe a little bit of tepidness in the U.S. consumer, again, in the tourists. But again, we think that's the time to get excited about a stock when it's cheap, especially when it's a 150-year-old brand that does everything from make the Super Bowl trophy to star in movies.
All right, let's talk about that volatility that we've been seeing in the markets lately. I mean, this won't show up in the earnings report, but as wealth is wiped away with these market declines, I mean, will that keep people out of the stores?
Yeah, I don't think in the U.S. actually. I think the U.S. consumer that is, buying a very high-end Tiffany ring or a Tiffany gift is probably already thought about that purchase and is going to make it. On the other hand, the more fashion consumer, some of the lower price points, that's more job and employment outlook related. All those indicators are actually heading up. I know the confidence report this morning for U.S. consumers is pretty strong too. So I don't think Tiffany's going to get too much of a whack from the stock market volatility. Now, obviously, if we went into another full-blown financial crisis, that would be a different horse of a different color. But I don't think we're there now, and I don't think that's an issue for Tiffany.
All right, but Tiffany does have some exposure to China, and of course there are, significant worries that China won't meet its 7% growth target this year. So what does that mean for Tiffany?
Yet China's growth or lack thereof is a bigger issue for the luxury sector in general, especially the European luxury makers, since a lot of their stocks have risen as the euro has weakened. But now the question is, if the Chinese currency is going to devalue over the long term, will that take a chunk out of their earnings growth? I'm actually, not too bearish on China. I think growth is going to be a little more slow and a little, tepid over the next, maybe even the next few years. But, Tiffany's actually less exposed to China than their European counterparts. And I think overall, wealth growth or consumer middle class growth is going to be very positive in China for the long run. And it's a huge number of consumers, so I think it's a big positive.
All right, Paul, we'll leave it there. Paul Swinand from Morningstar here with a preview of Tiffany's second quarter results. Paul, thank you.
Thank you.
I'm Scott Gamm, and you're watching The Street.